I've found the banks to be incredibly difficult to deal with, almost as if they don't want you to assume.
Hey there, everyone. Dave Barlow here with the gang from Sell for 1% Realtors. And we are doing our term of the week. One more week. And our term of the week this week is loan assumption. All right, guys. Tell me what you think about that.
Big waste of time is what I think about it. So a lot of agents I don't think have been down this road yet, which I find surprising. I mean, there was a couple months ago when rates first started to kind of spike. I took a couple of my listings and added that to the advertisement that we have an assumable rate at 3.75% with this much remaining and this many months left. So the issue that I ran into with it, in theory, it's great. So an assumable loan is a loan when you buy your house and get your mortgage. When you go to sell that house, there's a clause in your mortgage that says your buyer can assume your mortgage at that interest rate. So the last 10 years and rates are going down, no one's assuming a mortgage. But now that rates are going up, you can access that seller's 4%, 5%, whatever it is, interest rate. What in practice I found to be the issue, and I'd be curious if you've been down this road yet, Dad, or anyone that's watching this in the comments, leave one if you've done this. I've found the banks to be incredibly difficult to deal with, almost as if they don't want you to assume the 4% interest rate. They make it challenging, and really the only complication I've run into is that if you're borrowing, let's say it's a $300,000 house, and you're going to assume $100,000 at 3%. The extra money is going to be a second mortgage. And so you can't walk into Huntington Bank or Chase and say, I need a second mortgage on a purchase. Nobody wants to be second. So you're going to be forced to go through the bank that has the primary mortgage to assume that and then take a second out with them. And so it can be done. I haven't been successful yet. But if rates go to 9%, 12%, whatever, Bidenomics, baby, I think that it'll become more and more common.
Yeah, I think that we need to talk to a lender. And so maybe tomorrow when we get Rich and or Ryan online here, we can talk and maybe do another addition to this video. It seems like to me that the problem is with the lender that holds the first mortgage, that they don't make any money by just redoing that mortgage by the assumption. The lender like us, they make a commission based on, if it's a $400,000 house and there's a $300,000 assumption, then the lender is only making a commission on that $100,000 difference. And it's not enough money for them. I know you guys run into this as well. A lot of lenders don't want to do deals like under $50,000, under $75,000,
right? Because
they don't make any money. And so I don't know if that's the same case here or not. We'll have to get some more information. But for a buyer, a loan assumption is a good option to the 6.99% interest rates that we're seeing right now. Jamie, have you had any conversation with your buyers about a loan assumption?
Yeah, and I have some buyers that reach out specifically about loan assumptions. And yeah, I mean, the truth is on the buying side, it's definitely going to be a situation where you have to hustle to make it happen. But again, I think banks make it incredibly difficult. And if I'm not mistaken, is it just FHA and VA loans that are assumable?
Correct.
Are conventional loans also assumable? Right. So
typically are not.
And I mean, a lot of times you run into conventional loans as opposed to FHA or VA loans. And but for VA buyers especially, I think that you go VA to VA on an assumable loan, it's, going to be huge for you as a buyer. But navigating those waters is definitely not for the faint of heart.
Yeah, and that's where, as we're talking, it's like, that's what we do as a problem solvers. I mean, so it's like if I was representing a buyer and that's what you wanted, I'll get to the president of the bank and we'll make it happen. I've not been down that road yet with the buyer. It's interesting to hear you talk about it, Dad, because logically that makes sense that they're not making any money on it. So we're not going to push it or work hard. We'll just drag our feet until they finally get tired and go somewhere else. I always kind of thought it was because I'm letting you borrow this money at 3% when in reality it's costing the bank a hell of a lot more at today's rates. And so they rather get you back up at a normal rate where they can make some money. But what you're saying makes a lot of sense. I never really considered that.
Yeah, and that's why I think there's, a little dragging of the feet. But it's like anything else. The squeaky wheel gets the grease is the old saying. And, we tell our clients all the time, the handymen here in Columbus, Ohio, are worth their weight in gold right now. And what I mean by that is that in order to get a good handyman, they're normally 2-3 weeks out, and these guys are charging $7,500 an hour to come, do work at your house. Now, you can get the guy to come for $25 or $30, but you're going to get $25, $30 worth of work, in my humble opinion. The same thing with these lenders is that I'm going to put the $400,000, the $500,000 deal on top of the stack,
right,
and the $75,000 deal at the bottom of the stack. Because where am I making my money? What's in it for me? And that's why I think that you see these extended periods of time for closings. And so let's see if we can't dig somebody up here that's an expert in loan assumptions, because I think it's a great thing for a buyer and also a good thing for the seller.
For sellers. Yeah, it's a great selling feature to say you can assume my mortgage rate.
Yeah, I'm selling a house for $500,000. I bought it 2 years ago for $350,000. You can assume the loan at $340,000 because I've only paid $10,000 down, and so your second mortgage, as you mentioned, is only going to be $160,000 at the higher interest rate. So
right,
it is a good deal for both sides, but I'm seeing a lot of the same discussion that they're difficult to do. And so it might be like a short sale, back in...
I was just going to say, Dad, it reminds me of the short sale, and then it's like, okay, so is it really nefarious where they don't want you to do it, or is it just they haven't done it for 10 years either? Like, they don't have anyone on staff that is the expert that can clear these out yet.
Well, they haven't done them since the 1980s when interest rates were 17%. And so... I think that might be part of it, too. They just don't have anybody in-house that knows how to get these things done. So kind of like short sales.
Jamie Daimler, if you're looking for a consultant, I'm available for hire. If you want to bring me in for the reasonable fee of $10 million a year, I'll clear all these out for you guys.
There you go. All right, guys, we'll keep assumable loan assumption in your quiver of arrows, and we'll get it figured out for you. If you got any questions or you like this content, please be sure to subscribe, like this video, click the bell to be notified as we come out with new content each week of interesting discussions like loan assumption. Until next week, this is Dave Barlow reporting.